Hi friends, good evening everyone. How are you? I hope you are doing great. In yesterday's class, we have seen RTP November 2022. For those students who are writing exams in November, we have seen RTP for Group 1 and Group 2 accounts. That means accounts and advanced accounts. Okay. So in Group 1, because of lack of time, we covered all the questions from accounting standards, but one question is left, which is borrowing cost. So I felt that is very important model, and it is not a regular model which is covered in your study material or any of the previous questions. So this RTP model is it's not a complex problem, it's not a peculiar problem, it's a very basic and simple concept, but a new model which you probably might not have seen before. In my regular classes, I have covered one example which is similar to this, not exactly same, but for the benefit of students at large, I thought let me solve this RTP problem and give it. So let me share my screen. So this is where we are. So question number 20, borrowing cost, accounting standard 16, borrowing cost, which is our question number 20. Harish Construction Company is constructing a huge building project consisting of 4 phases. It is expected that the full building will be constructed over several years, but phase 1 and 2 of the building will be started as soon as they are completed. This is a very interesting phrase. Do you remember in borrowing cost, when you can capitalize the borrowing cost on a qualifying asset, till what time you can capitalize the interest cost? Do you remember till what time borrowing cost can be capitalized? Till the project or any part of the project, if interest cost can be apportioned, that particular part of the project or full project, when it substantially completes. Maybe some petty administrative works and all are pending, but if it is substantially complete and ready for use, then you have to stop capitalizing the borrowing cost. Subsequently, once the asset is ready to use, that substantially ready to use, after that, if you pay any borrowing cost, that should be charged to P&L, that cannot be capitalized. So basically, this question is about till what time borrowing cost can be capitalized. Till what time borrowing cost can be capitalized. This is comparatively a new topic. If you look at the regular problems of ICI study material, this kind of concept is not covered. Now let us see. Following is the detail of work done on different phases of the building during the current year, rupees in lakhs. Cash expenditure, they have given phase 1, 2, 3, 4 in columns. Cash expenditure, they have given 10 lakhs, 30 lakhs, 25 lakhs, 30 lakhs. Okay. Buildings purchased 24, 34, 30, 38. So now you tell me, buildings purchased, is it a qualifying asset? We assume it to be a qualifying asset. Okay, but actually, technically speaking, if you purchase an asset, it cannot be a qualifying asset. For example, I purchased building. When I purchase building, even if I borrow money, the interest cost, whatever I'm paying to the bank or on any loan, cannot be capitalized. It should be expense to P&L. Because what is a qualifying asset? Which takes substantial time for completion. So that means when you are constructing, when you are commissioning a plant, which takes more than 1 year technically, or when you are constructing a building, then you can say that it is a qualifying asset. So this building purchased is something which I personally did not like. They could have given something else here. And also cash expenditure, they did not tell what is this cash expenditure for. Is it a qualifying asset? We don't know, but we assume, in lines with the solution given by ICI, we assume both these are qualifying assets. That means what is the qualifying amount of expenditure on project phase 1? 34. phase 2, 64, phase 3, 55, phase 4, 68. So total expenditure of all phases is 221. This is what they are saying. Is it right? Let us see. Let us take in one Excel sheet and let me see phase 1. Phase 1, phase 2, phase 3, phase 4 total. So this is part of the project. This is amount rupees lakhs. So what is the amount they said? 34, 64. Next one is 55. Next one is 68. So total 221. Correct. So they have given total 221. But loan is not 221. Loan is only 200. Okay. If you look at the loan, it is not 221. Loan is, hello, Mr. Bill Gates, what happened to you? Okay, so if you look here, loan taken at 15% at the beginning of the year, loan is 200. So what is the amount of loan? 200. Interest rate 15%. Therefore, interest cost per annum. What will be the interest cost per annum? 30 lakhs. So 30 lakhs. Now the question is simple. When you pay interest to bank or to any financial institution or to any of the lender, you have borrowed money. So you paid interest. What will you do? Simple. Close your eyes, charge it to P&L. So there is no other option. So interest cost account debit to cash or bank account. This is being interest paid. Then profit and loss account debit to interest cost. So first one is payment entry being interest charged to P&L. First one is payment entry. Second one is charging expenses to P&L. So this is in the normal course. But accounting standard 16 says there can be an exception to this situation. So this yellow color journal entry is a regular normal journal entry. However, if the borrowing cost is incurred on construction or production of a qualifying asset, such borrowing cost may be capitalized. This is the concept. If borrowing cost is incurred on construction or production of a qualifying asset, acquisition, construction, production of a qualifying asset, such borrowing cost can be capitalized. If we are capitalizing it, then you cannot write profit and loss account. You have to write capital work in progress account debit to interest cost account in borrowing cost capitalized. This journal entry we write during the construction period. Till the asset is constructed, we put in this account. Once the construction of asset is complete, on completion of the asset, then fixed asset, or you may write non-current asset, whatever it is, like it can be factory, it can be building, it can be plant. You will debit that particular head, debit fixed asset account or non-current asset account, debit to capital work in progress. So whatever the interest you capitalized and made it a part of capital work in progress, that will be reversed while creating the fixed asset. Okay, so basically this yellow shaded journal entry without loss of generality, that is the journal entry for expensing of interest to P&L. What is the exception? Capitalization. So borrowing cost accounting standard 16 is all about this. Now the question is, this particular company has incurred this 30 lakh rupees of cost, out of which what can be capitalized? Pavan sir, can be capitalized all 30? No, because they are saying phase 1 and 2 are complete during the year. So you can capitalize only proportionately. So let us continue the problem. So loan taken 15% at the beginning of the year, 200. So we have calculated interest, which is 30 lakhs. During the mid of the current year, that means half. During the mid of the current year, phase 1 and 2 have become operational. Oh my God. So phase 1 and 2, whatever the proportionate interest cost or borrowing cost that is attributable to phase 1 and 2 can be capitalized up to half of the year. Remaining half of the year, what is to be done? The borrowing cost should be expensed. Now the question is, but Pavan sir, what is the interest attributable to phase 1 and 2 is not given in the question. Because it is not given in the question, we have to calculate proportionately. So how do we calculate proportionately? Now look here, this 2 is phase 1 and 2. Yes or no? This 2 is phase 3 and 4. Phase 3 and 4 are not yet completed. So there is no problem. So these 2 are completed. So how much? This is 34 plus 64, 98. And similarly, for project 3 and 4, it is 123. So total 98 plus 123 put together is 221. Correct? Now, look here carefully. Look here carefully. I am writing a small chart. Total interest cost or borrowing cost is equal to 30 lakhs. And in this, can I say there are two parts. One is borrowing cost incurred for phase 1 and 2. Other component is borrowing cost incurred for 3 and 4 phases. Okay. So let me put a roster bracket here. Dear flower bracket, where are you? Ajao. Okay. So let me split this into 2. So total borrowing cost, let me split this into 2. So this is phase 1 and 2. Phase 1 and 2. This side, it is phase 3 and 4. So total borrowing cost attributable to phase 1 and 2 is equal to, listen carefully. Can I say total 30 lakhs? In that, what is apportionable to 1 and 2? Out of 30, look here. Can I say 98 divided by 221? 98 divided by 221 is proportionately used for 1 and 2. Total capital expenditure incurred is 221. In that, 98 is for phase 1 and 2. So what is the interest that should be charged to phase 1 and 2 for full year? 98 divided by 221, isn't it? So 98 divided by 30 into 98 divided by 221. Okay, that is equal to 30 into 98 divided by 2. So that comes to 13.30 lakhs. Correct. Similarly, for phase 3 and 4, can I say the proportion is 123 upon 221? 123 upon 221. Borrowing cost is equal to 130 into 123 divided by 221. Is it 123? Yes. Is equal to 30 into. Simple. We are taking proportion. 221. So this is 16.69. But, hello, hold on. This 13.30 is for full year. This is for full year. But first 6 months, borrowing cost can be capitalized. Next 6 months, borrowing cost can't be capitalized. So on this 13.30, I need to take divided by 2. That means out of total interest cost, proportionately, whatever is attributable to phase 1 and 2 is 98 upon 221, which comes to 13.3 lakhs. But this is for full year. In the question, they said the phase 1 and phase 2 of the project, phase 1 and phase 2 of the project is completed after 6 months, half year. So only for that half year, this can be capitalized. So this can be capitalized. This is to be expensed to P&L. Why? This is subsequent to completion of construction. When it comes to this 16.69, total amount can be capitalized because even on the balance sheet date, phase 3 and 4 are still under construction. So accounting treatment. of borrowing cost. Okay, interest relating to phase 1 and 2. Interest relating to phase 1 and 2. Total borrowing cost that is attributable to 1 and 2 phases is 13.30 lakhs. Since the project, since these phases are completed and operational in the middle of the year. What did they say? In the middle of the year, during the mid of current year. That is the word they used, during the mid of the year. Interest for first 6 months can be capitalized. That is how much? 6.65. Balance 6 months interest is incurred after completion of this phase. Therefore, as per AS 16, this borrowing cost can't be capitalized and this should be charged to P&L. You understand? This is about interest relating to 1 and 2. Interest relating to 3 and 4. Okay. Total borrowing cost that is attributable to 3 and 4 is 16.69. Or you can say 16.7 approx. The whole borrowing cost can be capitalized since phase 3 and 4 are under construction, under work in progress stage. You understand? So if you are passing the journal entry, you can pass it like this. If you are passing the journal entry, you can pass it like this. Interest cost account debit to cash or bank. How much? 30 lakhs. 30 lakhs. Out of this, how much can be capitalized? Phase 1 and 2. Okay, which is nothing but your fixed asset. Account debit. Okay, how much it is? 6.65. Capital work in, no, sorry, P&L, profit and loss account. Profit and loss account debit, 6.65. Capital work in progress, which is nothing but 3 and 4. Phase 3 and 4 are still under construction, so we call it capital work in progress. 16.7 to interest cost. 30. That's all. That's all. This is how we pass the journal entry. If they ask you to pass journal entry, you can. But even if they do not ask also, you can show this journal entry because journal entries enhance understanding. Journal entries are the litmus test that you're understanding the concept. So phase 1, this is creation of asset, capitalization, asset. This is expense. This is also capitalization, but since the asset is not existing now, we are putting it in capital work in progress. That's all. This is the answer. So let us look at the answer. This is our answer given in beautiful ICI study material. So you can look at it. Interest expense on loan, 30 lakhs, correct. Phase 1 and 2 put together, 34 plus 64, 98, correct. Phase 2, 3 and 4, 55 plus 68, 123, correct. So this 221 lakhs comprises 98 lakhs, the construction of which is complete, 123 lakhs, the construction of which is yet to complete. Total loan is 2 crores. On that 15% is 30 lakhs. So they calculated interest on loan for phase 1 and 2. 30 lakhs divided by 221 lakhs into 98. That is what we have done. So approx it comes to 13.30. That is what we got. For the other part, phase 3 and 4, it is 30 divided by 221 into 123. That comes to 16.696. That is what we got. That's all. And they have written 2 paras after that. And these 2 paras, even we have written, and I told you what to do. That's all. So this is the end of RTP. So I thought this is interesting question, and you will be benefited if I teach this in the class. That is the reason I have done this problem for you. Okay. I wish you all the very best. I know you have few days to go for your exams. I'll pray for you. All the very best. See you soon.